couple of changes taking place in the area of taxes. So this should only be a couple of minutes. I mean, there's really not much to talk about. Basically, I mean, it was pretty widespread tax reform, and the stuff that Jerry's handing out right now kind of gives a little bit of a summary and a breakdown as well of what I'm talking about. But on the personal side, the personal tax side, one of the big changes is that the standard deductions have been increased to $12,000 for single filers, $18,000 for head of household, and $24,000 for the married filing joint tax filers. And basically that's double from where their current rates are. Currently for an individual it's $6,500, $9,350 for head of household, and $12,700 for married filing joint, which basically means that there's going to be a lot fewer people itemizing for their taxes in 2018. Currently there's a $4,050 personal exemption that benefits families for each person as well as for their children, and that's going away. But something that Dave wanted to talk about was they're expanding the child tax credit that can help offset some of those losses. Specifically, under the new rules, the child tax credit has doubled to $2,000 per qualifying child, and it is phased out as you make more money. But also a new feature to the Tax Cuts and Jobs Act is that there's a $500 credit for dependents who are not qualifying children. This can apply to a number of people supported by the taxpayers, including children over 17, adult children with disabilities, or elderly parents. So if you end up moving in with your children, they might get to claim you as, or get a credit for you. Jerry?
Yeah, I'm looking forward to it.
On the itemized deduction area, one of the big things that they've been talking about is the state and local tax. They're capping the amount that people can use as an itemized deduction in that area. It's being capped at $10,000, and that basically means that between your property taxes and the money that you have either withheld or paid in estimates to the state is going to be capped at $10,000 to drive your itemized deductions. With regards to the mortgage interest deduction, only the first $750,000 of mortgage debt will be deductible. So I don't know how many people that really affects here.
Well, you can get half of it.
But another one for itemized deductions is the deduction for medical expenses. They're changing it. Instead of being 10% of your adjusted gross income, it's now dropping down to 7.5% for everybody, where before it was just 7.5 for elderly. Now it's for everybody. What else we got here? Well, another big change for the itemized deductions is in the area of the miscellaneous deductions. And that's basically like your tax preparation fees, your unreimbursed business expenses, like home office deductions, or anything that's not reimbursed by your employer. They were subject to a 2% adjusted gross income floor, and now they're basically gone. They're just not allowing those deductions anymore. And other ones, well, with not on the deductions side of it, but capital gains and qualified dividends, they're basically staying the same as they are now, where they have the 0% rate, a 15% rate, and a 20% rate. So taxpayers that still have taxable income under $38,600 won't pay any capital gains tax. And you'll pay 20% if you have over $425,000, and then basically 15% is what you'll pay on capital gains and qualified dividends, anywhere in between there. The estate taxes, instead of repealing the estate tax, they actually doubled it. So they doubled it to $11.2 million for individuals and $22.4 for married couples, moving up from 5.1 or 5.6 million, but, and also they raised the gifting amount to $15,000 per donee, where it was 14 before. They made some other changes in regards to like 529 plans for education savings, where now they can starting in 2018, you can use up to $10,000 per student tax-free for the cost of public, private, or religious elementary or secondary schools, instead of just college. Basically, you can start to use it for other things as well. The alternative minimum tax, they're adjusting the dollar figures for the alternative minimum tax, and the bottom line is that there's going to be less people being exposed to AMT than what there has been in the past because of the phase outs and the income exemptions. If anybody's planning on getting divorced in 2018, with the new laws in place, the new divorce decrees starting in 2018, alimony is no longer going to be taxed to the recipient, but it also won't be deductible for the person paying it. That's a change, but that's only for basically new divorces. The mandate for health insurance, the penalty for those taxpayers without health insurance has been eliminated, but that's in 2019. Now on the business side, there's quite a few tax changes as well. Starting in 2018, the corporate income tax is permanently reduced to 21%. The Section 179, which is the ability to write off assets acquired in the year that you purchase them, that cap increased from $500,000 to $1 million. The net deductibility of net interest expense will be limited to 30% of the earnings before interest, taxes, depreciation, and amortization, and then 30% of the earnings before interest and taxes thereafter. So companies that are highly leveraged and have a lot of debt won't necessarily be able to write off all of their interest expenses like they have in the past. Net operating losses for businesses are limited to 80% of taxable income, so they can't just carry forward and take rid of all their income. The corporate alternative minimum tax is being repealed. Another big one is for sole proprietors, S corps, limited partnerships. They're now going to generally be able to deduct 20% of their qualified business income from their taxes, which there are some exceptions with different areas of business and that type of thing, but for the most part, you're going to be able to deduct a bunch of their income from their taxes. There's an issue for, well, there's a thing for farmers, which they'll probably change at some point. But if a farmer sells their grain to a qualified co-op, that they'll be able to deduct 20% of their gross sales from their income and not just net income. 20% of their net income, so it would be 20% of their net sales from their taxes, which could make a huge difference for farmers out there, as well as local small elevators and stuff too. It could really have an effect on them. Just today now I got an updated sheet because they never make changes. And on the new sheet that they sent out, there's not a lot of changes that they wrote here, but for people that have rental properties, you're going to be able to expense even like roofs or HVAC equipment and fire protection alarms and stuff, as opposed to having to capitalize them over a period of time. And also that farmers that buy new equipment can depreciate over 5 years instead of 7 years on a lot of property. But yeah, I mean, that's just a brief rundown of the short tax, bill that came out. And Now I'm going to defer to Jerry for questions.
Good idea.
Yes?
If someone has a Uniform Gifts to Minors Act and the kid turns 21, is that money taxable income to a 21-year-old kid who gets a distribution from the Uniform Gifts to Minor Act distribution?
No. That, I mean, it, because it was tax, I mean, I don't know if they've really changed much on those types of things, but they're, generally, because it goes to, you know, it becomes the kids'
Right.
assets, and so eventually, you know, with the earnings and stuff, they might then pay taxes on it, but,
Thank you.
yep.
I do have one.
Yes.
So in 2018, so if you have rental properties, you can only deduct 10,000 of your property taxes versus before you can do all your property.
Well, not on rental properties,
Oh, not a rental.
this is just on the personal side.
Okay, all right.
So if it's for a, you know, a corporation or a rental, that you can still write off
Okay.
the full. Yes, Marty?
So some of those things that you can't write off now, is there other spots to put them?
We're not allowed to say that out loud. This is being recorded.
Boyd is recording this for the people who aren't here right now. But, you know, depending on if you have, I mean, that's, a lot of those are on the personal side. So on the business side, you can still have those, you know, for different areas. So it's just, if you're a W-2 type of employee, where if you have your own business, you know, you'd still be able to write off your mileage and all of that sort of stuff. It's just on the personal side for the W-2 type unreimbursed employee expenses. Yes?
So, excuse me, there's the section for tax changes for businesses, and then there's the section about pass-through entities.
Yep.
So for an S Corp, are the items that are listed under the tax changes for businesses, that's applicable as well as the pass-through? Or is this just C Corps and the black section would be S Corps?
No, well, a lot of the changes for businesses, they're kind of carryover. I mean, they're for both of them. You know, for like the section 179 depreciation.
So that's all applicable for S Corps.
And-
the S Corps also have the pass.
Yep, exactly, yep. Yes, Dave?
So how is the federal government going to replace all of this money that they're not taxing us on in 2018? Are there an offset in what they're going to spend?
That you have to bring up with the politicians, but,
Listen to the State of the Union tonight. He'll
Oh,
answer.
yeah, exactly. Listen tonight. I'm sure Mr. Trump will explain exactly what his plan is. But basically, they want to create jobs, and by, you know, cutting all this stuff and have people spend more money. Don't know if it's going to work, but.
All right,
Yeah, Mary, thank you.